Hi, everyone. Thank you very much for joining me for this presentation. My name is Brad Renard. I'm the Chief Publisher of Upside Options. And I just want to make sure you guys can hear me. So let's see who is, okay, we got some people. Okay, so if you can't hear me, or if you can hear me, please just send me a quick chat or a question and just say, yes, I can hear you, everything sounds fine. Okay, so let me get started here. And my screen should be changing. Okay, so I should be on the first slide that says questions to address. All right, so I got a few people that said that you guys can hear me. That's good, thank you. And then just make sure that the slides are moving. If they're not, then let me know, please. Okay, well, thank you. Okay, so questions to address. Are the major indexes are taking out new highs? So is this market going higher? How expensive is this market? Can it get more expensive? If the market pulls back, where will it find support? What will be the best investment strategies for the first half of 2021? For example, buying indexes or ETFs, stock picking, covered calls, non-directional trading strategies. Should I sell some of my passive ETFs and stocks as this market continues to climb higher? Should I add short exposure, hedges to my portfolio? What will outperform in early 2021? Value, growth, defensive, technology, small caps, mid caps, large caps? Should I buy bond funds? And then we'll dig into Pinnacle. So I'll provide an overview and a quick update on Pinnacle strategy, and we'll look at a past trade. Okay, so that's what I plan on covering. A little bit about me. I'm the Chief Publisher of Upside Options. I founded the newsletter and auto trading service in 2004. I'm also the Chief Investment Officer of QTR Capital Management. That is a registered investment advisor firm. I'm an adjunct professor. I teach at Chapman University, the Agros School of Business and Economics, and I focus on management science, statistics, econometrics, and analytics. I was in high tech for 20 plus years in Silicon Valley. I started off my first job out of engineering school. I was at the GE Space Division, that was in New Jersey. And then I moved into lots of other companies, probably 7, 8 other companies, marketing, sales, VP of sales, marketing. I was a co-founder of a company. I was in Japan for a couple of years running a sales and technical support office for one of the companies. And all of those were located in the Bay Area, at least for headquarters. My education, I have a BS in physics, electrical engineering, that's from Columbia, and I have an MBA from the Chicago Booth School of Business. Okay, and then if you have any questions, just let me know. Just send a question and I will be watching the panel here. Okay, so for Upside Options and QTR Capital, we have the same options or the same strategies at QTR Capital. It's just for accounts that are 100K or greater. So when a client is trading one of our strategies and they want to add more money, and if it starts exceeding 100K, then we'll ask them to move over to QTR Capital, and those are managed accounts. Just FYI on the difference between Upside Options and QTR. So QTR is a registered firm. Upside Options is a newsletter, a non-registered investment publication newsletter. Available strategies. We have Opportunity One. So this is new, and I just got this going in the last month because I started seeing breakouts of all of the still lagging stocks, the stocks that still have not come back. And so this portfolio is going to do well, probably over the next 12, maybe 15 months, but my guess is we'll probably be done in 12 months and then we'll shut it down. We'll probably hit a 50, 60% gain, maybe a 70% gain, just don't know. But we're buying depressed restaurant, retail, department stores, clothing manufacturers, hotels, travel, leisure stocks that were all hit by COVID. And these are the ones that are still down, but they're just starting to show some breakout potential. This is another new one, and this one is a good all-purpose general long-running strategy that can be put in most portfolios. Global Sector Rotation ETF. So we're diversifying across the globe. We buy ETFs. We watch 90 industry sectors and country ETFs, and we have special tools that kind of show us nice visual graphics of relative strength performance of these ETFs. And we'll hold about 25 positions in the portfolio. So right now that one is up about 6% and it's nicely diversified. So if you're scared of the US, and many of us are, it's good to be diversified. Like I just added Germany, for example, just today. And I have Brazil in there, for example. And Indonesia looks pretty good. Thailand looks good. There's a few companies, now those are not in there right now, but I'm watching them closely. And those are types of positions that we can put in there. Big cap growth, we buy stocks, large cap stocks with strong technicals and fundamentals with market cap of greater than 10 billion. Small and mid cap growth, we buy stocks with strong technicals and fundamentals with a market cap of 250 million to 10 billion. Sector rotation growth, so that's for stocks. We buy the strongest stocks in the strongest industry sectors. This one's a little more momentum. So when something breaks out and it's in a very strong sector, we'll ride those usually for 90 days, maybe a little longer. If we can get 6 months, that's pretty good. We're looking for a 20%, sometimes 30% gains on these stocks, and then we'll book our profit. Contrarian, we're buying stocks that have been out of favor for 6 to 12 months and starting to recover. Iron Condor Pinnacle, that is a non-directional, income-generating, conservative option strategy that typically generates 3 to 5% per month. So we'll talk more about that one later in the presentation today. And right now it's generating higher returns because elevated volatility is very nice and allows us to bring in higher premiums. And that might last through March of 2021. And then leveraged dividend income. This is we buy a concentrated basket of blue chip dividend paying stocks. We lever up the positions by 4 times, and then we open up hedges. So we use some of that cash that we levered up with to buy, we use about half of it to buy hedges to reduce a lot of the downside risk. So targeted return is 9-11% annually. This one's more of a steady Eddie type of portfolio. You don't need to predict the future direction of the market. Drawdowns are dramatically decreased, from corrections and crashes because of the hedges. So it's a nice all-purpose long-running type of portfolio that can generate about 9 to 11% annually. Okay, let me just check to see if we have any questions. No questions. Here are the returns for Pinnacle. This is on the website, upsideoptions.net. For the 2020, we're sitting at about a 24% gain, and actually it's a little higher. So for December, it could be a very good month. Sitting right now at a plus 15.5% gain, and I just won't know. Just really don't know until the end of the month. I could give some of that back. I can give a lot of that back, or I can keep on generating premium and increase it up to, increase it more. And what I like about the market since just a couple months ago, it's become highly optimum because we finally got past the election. We needed to get past the election. The market was just too volatile and too uncertain, too much fear. Once we got past the election, volatility came down to about 20. That's the VIX. That's really nice. It's a higher elevated volatility, but it's very manageable. That allows us to open up just 1 week in duration trades, because usually I have to do 2 week. So I can open up 1 week duration trades. Each trade is bringing in 30 to 40% returns. And we can increase a portfolio pretty quickly when we have these higher volatilities. So I'm crossing my fingers that this will last for another couple of months through March, because it makes it really nice. So for our stock picking strategies, our differentiation is we do 4-level quantamental analysis. So we're blending technicals, fundamentals, factor-based, quantitative. Sometimes we're long short. I would say we're always long short, but the short might just be general purpose broad hedges. We just do hedges like on the SPY, the S&P 500. These are not really long short strategies where we're going long on some stocks and short on others. I've had several strategies in the past that we did that, and I had a few traders that were doing those, but those are difficult and they're a lot of work, and sometimes they're just tough. It's a tough strategy, and so right now we're not doing long short, but I am showing short as general purpose long hedges in the portfolio. So when we do the hedges, we use a unique methodology that makes the short trades, the hedges, almost free. Okay, If anyone has interest in learning more about that, we can talk about it. So we follow strict exit rules or well-defined exit rules. We can let most of the winners run, but the exit rules are fast enough where we can lock in gains and protect capital. So as an example, in 2018, October 2018, we went from 75% allocated to 15% allocated in less than 6 days. And that's when we had a really nasty pullback at the end of 2018. And so for 2018, all of our portfolios were up 18 to 25%, and the benchmarks all closed in the negative. So it's nice that we follow well-defined exit rules. We do not let stocks draw down and keep on drawing down. We'll book those losses. Usually when I keep the losses under 5% per stock, maybe it's 7%, 8%, and that's okay because we just kept and held on to 92, 93, 94% of our money because we're not going to be right on all of our trades. So our 4-level scanner, we do a macro analysis first, looking broadly at the entire market, technicals, breadth, fundamentals, sentiment. That helps us modulate bullish and bearish exposure. Then we do a technical scan. We're finding the high probability setups. Then we do a fundamental scan. We're looking for strong or weak companies, primarily strong companies, because we're just going long on those. Then we do a quantitative screen, and then we're looking for probabilities. And I'll show you a little more on what we do with that. And we're looking for probabilities that the pattern, like the breakout, will follow through. And then technicals to trigger entry and exits. About 4 to 5% of capital is allocated to each position in our portfolios. Most of our portfolios, I have 25 stocks, 23 stocks, 20 stocks, kind of in that range. So they're somewhat concentrated, and we like that approach. Allows us to select the right stocks and get the highest returns on those. Factor-based quantitative analysis, a little more on this. So it's basically, when we say factor-based quantitative analysis, here's one summary slide on this. It's the use of econometric statistical mathematics to provide predictions such as probability that a stock will break up or down through a particular level, and probability that a stock will move a particular magnitude up or down once it breaks out. So this requires several years of education in statistics and econometric mathematics, along with 2 or more years of developing the models and optimizing the models. And this is a typical output. So we'll run 3,500 stocks typically through the tool. It's multi-factor. We end up with all these probabilities for all the stocks, and this gives us final numbers to use when we are making final selections on what to put into the portfolios. And it's nice. It actually does give us an edge. Okay, snapshot of the current market. We'll start getting into the market now and charts. So we had a COVID crash of -35 to -45%, just depending on what stock or index you're looking at. That was early March 2020. Everything started around February 27th when this market started rolling over. And that was one of the deepest, fastest, most violent crashes I've personally seen in 25 to 30 years. Was not helpful that the market was at an all-time high. We were actually melting up from November through February, and we were sitting at 19.5 times forward earnings. The market was overbought, overextended, all-time highs, and then it crashed. So that was not a good situation. The highly desirable stocks rebounded by July in about 4 months, and then they started breaking out to new highs. So for example, the ultra caps, Apple, Microsoft, Amazon, they hit all-time highs around July, and then they started breaking up to new all-time highs. I'm sorry, they hit kind of their past highs, and then after July, they start breaking out to new all-time highs, and then they start pulling up all the indexes. The SPX has been taking out higher highs ever since that July time frame. The Qs and the NASDAQ composites, they look overextended, and they went up really fast. So buying stocks in March and April did well, up about 35 to 70%. And for our big cap strategy, we had room in the portfolio, and we were at about 50% allocated at that time. And so we bought about 12 stocks, and they're all up. They were all up, and we already booked our profits. They were all up 40, 50%. The non-directional strategies like Pinnacle are now highly optimum. So we'll talk more about Pinnacle. And they're bringing in higher than normal premiums due to elevated volatility. Okay, let's look at the charts. First, I'm going to look at the weekly charts. So this is weekly. Every candlestick represents 1 week of trade. This goes back to 2018. I show the 17-week EMA, that's the red line. I show the 43-week EMA, exponential moving average, that's the green line. Whenever the 17 is above the 43, it's telling you that the market is in a long-term confirmed uptrend. Whenever the 17 drops below the 43, it's telling you be careful, the market is in a long-term confirmed downtrend. So we can see the SPX, here's Trump win over here. The whole market climbed about 30 to 40% in about a year after he got elected. And we had a pullback in 2019, but then it just kept on climbing, and basically due to his pro-business initiatives, wanting to cut taxes, wanting to build do infrastructure spending, things like that. So that was pushing up the market to all-time highs. Here we had the crash, COVID crash, V rebound, and then now we're taking out new highs. So this is an impressive chart. Would have never thought we'd be all the way up here this fast, but we are. And it's pretty expensive. We're trading at 22.5 times earnings. So that isn't a very expensive market, but the market can stay expensive for a while. Here's the Dow. Dow up about 40% after the election win. You can see that we're pretty much got a little choppy here, had a pullback. This was that late 2018 crash, or really a strong pullback that I talked about. This is where our portfolios all triggered exits. So we pretty much sold a lot of our holdings and booked in a lot of gains for the year. And took out a new high here. Here's the crash, down about 35 to 40% for most indexes. Small cap, mid caps got hit the hardest, and that's pretty typical, down about 45%. Pretty strong rebound. We're up to here now, new all-time high. NYC, this is a really ugly chart. So this was kind of the breakout back after the Trump win. This was the low. When we crashed with COVID, took out and retested those lows. Wow, that is absolutely brutal. Now we're taking out new highs, and that's actually impressive for this index. This is the NYSE, and it has more of the stodgy companies, older companies that have been trading on the New York Stock Exchange for many, many years, or if not decades. And for this one to break out is pretty impressive. IWM, small caps, this is a Russell 2000 index. Again, these are all weekly charts. I'm showing the 17-week EMA, 43-week EMA. Whenever the 17 is above the 43, it says the market is in a long-term confirmed uptrend, or at least this index is. So you can see when we got the breakout here from after the Trump win, market went up quite a bit, a long way. Nasty crash, retested the lows from the late 2016 lows, and then now we just finally broke out to new highs, and it just took off. So this is an interesting market. I think part of the problem with this market is that transaction costs are now zero. So all the fees for buying stocks and selling stocks have gone to zero. That got started with the Robinhood platform. And I think we're going to end up seeing more nasty pullbacks because things are just going to get overbought. And then when we have a pullback, it's going to be deeper. And that's what I'm seeing right now. So I don't like what I see in some of these charts, especially some of these stocks. 200, 250 stocks are just highly overbought and overextended. Something I would not touch, but people are still piling into them and trading them. And I think there's a lot of younger people with less experience and with no transaction costs. So they feel like they can just trade the markets. So pretty crazy times right now. So it is concerning me. Okay, here's volatility, VIX, and went up to 85. Last time we saw that was 2008, 2009. That was horrible. Can't believe that we got up there again. We're down to about the 20s, 21, but you can see that's elevated. So volatility has been kind of in the above 20, 21 since February. And that allows option selling strategies to do very well. So that's where Pinnacle comes in. So when they always say, when volatility is high, sell the options. When volatility is low, buy the options. Right now we're selling the options. Here's the yield on the 10-year Treasury, TNX. You can see that it's slowly climbing higher. The yield's around 0.9%. Tells you you don't want to be in bonds. As the yield is climbing, as interest rates climb, that's interest rate risk for bonds. So short-term bonds are fine, but you're not going to make much more than 1%. If you want something a little more meaty, longer-term bonds, but they're going to get impacted by rising interest rates. So as COVID slowly gets eradicated over the next 9 months, interest rates most likely will rise. Earnings. The black line is forward 4-quarter earnings for the S&P 500 index. And prior to the COVID crash, the 500 companies in the index were going to generate about $180 worth of earnings, went down to $140. So earnings were hit hard with COVID. The S&P 500 companies are now projected to generate about $165 worth of earnings over the next 4 quarters. So that's pretty impressive. What it tells you is that these companies, many of these companies in the S&P 500 are able to generate earnings. They're able to keep their revenue going, even though we have shutdowns here and there. And it just depends on what they make and what they're selling and what their channels are. But these companies are doing okay. And the market's trading at 22.5 times forward earnings. That's classified as expensive. If I wouldn't say, I'd call it very expensive. So we do need to be careful with this. But this is impressive. So we'll probably even get a little higher, and it looks like we're going to be back up to $180 worth of forward 4-quarter earnings in the next 6 months. That's my guess. Okay, let's look at some of the economic data, but I'm not going to show too much. Usually I'll have 3 or 4 slides with lots of graphs, but everything is so dislocated from COVID that it just doesn't matter. And as long as we have Congress, and if they can pass another COVID bill, we got more money just getting pushed into the economy. And as long as the Fed keeps on buying bonds and helping the companies, all the companies stay afloat, then we'll just kind of keep on chugging along until we can eradicate the virus. Non-farm payroll, it's, I think about, in general, we lost about 25 million jobs, and we got maybe half of those back. And there's about 3 million, maybe 3.5 million people that have literally left the job market completely. So they don't even show up in this data. So it's still pretty devastating. Unemployment rate's around 6.5%, maybe 7% in that range. But we're still short about at least 10 million jobs. And we watch the unemployment claims each week. So this is how many people are claiming, new unemployment benefits each week. We're still in the 800,000 range. That's a lot. That's about 3 times more than it's normally at. And it was in the millions initially when it first peaked. We had 6 million people, 5 million people, 4 million people claiming unemployment. Now we're kind of in the 800,000 range. It's kind of leveling off, but it's still very high. Retail sales, it's bouncing back. People are spending money. They're buying a lot of stuff online. So Amazon's doing very well. And a lot of people are still, going into Target, going into Walmart and shopping. And so it's slowly coming back. Non-defense capital goods orders, ex-aircraft. This is basically what are companies buying? What equipment are they buying for their companies? And at least we're above 0%, so it's growing year over year. So that looks decent. So the companies are doing okay, actually. Worldwide charts. We care about worldwide charts because that can impact our markets. And so we always want to monitor what's going on overseas. So I usually watch about 10, 12, well, actually more than that now, probably 20 ETFs that monitor worldwide markets. So IEV, this represents 350 large companies in Europe. Looks pretty good, near the highs. Here's Germany, took out new highs. I just put this in the global sector rotation ETF portfolio today. EEM, emerging markets, looks pretty good. This is an all-time high here. We'll see if it gets some breaks up through. Also, the dollar is weakening. So the dollar has been weakening, and that's good for emerging markets. Here's China. It broke out. It's testing this breakout. It just needs to stay below the breakout. I also have China in the global sector rotation ETF. Here's ACWX. This is the world less the United States. You can see the world is doing okay, not bad, or at least people think so, and so they're piling in. So I don't see any red flags here that can impact our markets. Okay, let's look at the daily charts. So this, I'm showing the 13-day EMA, red, 200-day SMA, simple moving average is the dotted line, 50-day EMA, exponential moving average, is the blue. So 50-day, 13-day, 200-day. We're at all-time highs. We're up to 37.20 as of today, pushed up to 22.5 times forward earnings. This market is expensive. Interest rates are extremely low, so people can make an argument that, hey, we need to be trading at higher multiples. That's a very high multiple, but it is what it is. Market is going to do what it's going to do, and it's expensive, but it might stay expensive for a long time. And the last time we saw 21 times earnings was in March, April of 2000. That was just the beginning of the crash of the dot-com crash and recession. And that was at 21 times earnings. So now we're at 22.5 times earnings, and I wouldn't be surprised if we start touching 23 times earnings sometime in the next couple of months. So yeah, this market wants to go higher. Here's the Dow Jones, broke out to new highs. Here's the NYSE. A little more stodgy companies, as I mentioned, but as long as this kind of stays over the 200-day line, it just tells you that everything is okay. NASDAQ Composite and the Qs, these guys got really expensive, or really overbought. I don't want to say expensive. I mean, I know they're expensive. I think they're trading at 35 times forward earnings for these. But you have a lot of tech stocks in the NASDAQ Composite right here, and we're at all-time highs. The Qs, all-time highs. This is 100 non-financial companies, mostly tech companies, the largest tech companies. The negative of these is that these ultra caps, Amazon, Google, Apple, they represent like 40% of this index. So when you buy this index, half of it is really Microsoft and Microsoft, Apple, Facebook, Google, and then the other half are the other 96 stocks. So I just don't like how these indexes are so overweighted towards the ultra caps. Here's a weekly of the Qs just to show you how I believe it is highly overextended. This is the weekly chart showing the 1743. Goes back to 2013. And this is something you should always have brought up. Bring up a weekly chart, show the 17-week, show the 43-week EMAs. And as long as that 17 is above the 43, it's telling you that the market and this index is in a long-term confirmed uptrend. So you can see that they've been in long-term confirmed uptrends for a couple of years before they pulled back or started consolidating and resting and taking a breather. And look how this, I always look at slope. So here's this slope here, here's this slope here getting steeper, here's this slope getting steeper, and then here's this slope here, just off the charts. So this is not sustainable. And I don't know how long it's going to last, but this is not sustainable. IWM, and this one just broke out and really took off. It's already up 12%, 13%, or even a little higher probably. So the small caps did take off, and they're looking good for the small caps. And the mid caps, they look very similar. Let's look at market breadth. Market breadth is something you should always look at. The advisory that we send out each Sunday evening, it's free. You can go to the website, upsideoptions.net, and you can opt in to receive it. Tweak has about 50 charts in it, and the very bottom charts are these two charts, and breadth are very powerful. They're one of the few true leading indicators to monitor. And whenever you see the S&P 500 advanced decline line, cumulative advanced decline line climbing like this, there's probably a 75 to 80% probability that that market's going higher before it doesn't. And then you can see the NASDAQ advanced decline issue. So again, when we say advanced decline on a daily basis, you take the number of advancers, like for this one's 500 stocks in the S&P 500, take the number of advancers minus the number of decliners on a daily basis, you end up getting a number, add that number to the past number. These are all cumulative. You just keep on adding that number to the day prior, and you end up getting this cumulative advanced decline line, basically number of advancers versus decliners on a daily basis, and pretty powerful. So I put a moving average on it. I got a 1740 on this one, and I have same thing on this one, 1740. And so whenever the 17, I look at it, whenever the 17 EMA is above the 40 EMA, it's telling me most likely that we're going higher or still going higher, believe it or not. Whether we agree with it or not, this market wants to go higher. Corporate bonds and high yield corporates. So high yield, more junk bonds. What this tells us is that investors believe that the probability of default is low for the companies that are issuing corporate junk debt. That means that, hey, they believe that the economy is okay, they believe the economy is going to be getting better, and that all these companies that are not doing that great and they're issuing junk debt are still going to do okay. So people are willing to keep on buying these bonds. You can make about 5% on these. But you can see the risk that you have. Look at the crash. So you had corporate high yield bonds, you're making 5%, but your investment went from 88 bucks down to 68 bucks, down about 25% or 20%. Pretty nasty for bonds, but that's the trade-off. You want 5%, but it did bounce back. This is higher quality debt, and it didn't do much better. It was down probably 15%, more than that. But it broke out to a new all-time high, and it's just telling you that investors believe that the companies that are issuing investment grade corporate debt should be doing okay over the next year. That's what it's telling us. So all that looks fine, no red flags. Market sectors. This is a tool that just gives me, I think I have about 70 industry sectors in this list, and it shows the ranking of these industry sectors. So for example, Robo, which is an ETF, Robo Global Robotics and Automation ETF. It has a three-part model or three-component model that ranks these, and it's ranked number 1 as the strongest sector. And actually Robo is in our global sector rotation ETF portfolio. It's been in there for a couple of months and it's up a lot. It's up like 13%. And I just marked the ones that really represent the US economy, because they're all leading indicators, so software, automation, copper, steel, metals and mining, dynamic software, small cap growth, et cetera, semiconductors. So these are all telling us, what that tells me is that this uptrend is healthy because all these sectors that should be leading are leading. So that's what I want. That's what I care about in this type of tool. Defensive holdings, gold, silver, consumer staples like Procter & Gamble, Clorox, for example, and then bonds. So for gold, it's basically telling me I would not be in it. I would want this to break out to new highs before I would get into gold. And there's a lot less fear now. We have vaccines rolling out. We're already kind of almost through the worst of COVID. And you already got a really nice gain on gold. So until gold breaks above this level, I would not touch it. I'd probably, I wouldn't get out of it yet because it's still over the 200-day line. Silver, same thing, it's still over the 200-day line. It's just definitely taking a breather right now. We just don't know which way it's gonna go. The dollar has been weakening, so that does give gold a tailwind along with silver, but it's still trending down. Treasuries, the 10-year yield is around 0.9%. You can see it's climbing, meaning that the bond funds are going to be are going to get hit. They're going to have negative returns. And consumer staples, well, it's breaking out with just about everything else. So it looks like consumer staples, if this market were so strong, consumer staples would not be breaking out. People would be getting out of Procter & Gamble, for example, but we still have major dislocations due to COVID, and people are still buying all kinds of stuff from Procter & Gamble and Clorox, and so I think these are still strong due to COVID. All right, we're going to look at a few industry sectors. We care about what the industries are doing. 6, 7, 8 of them, broad industry sectors for the United States, mostly for the United States. Industrials, these are leading indicators for the global economy, or at least for the US economy. So XLI industrials broke out to new high. That's a positive. That's good for the broad economy. Banks, they're popping up. Looks good, finally. It's telling you that interest rates should be climbing over the next year. That's why banks will start climbing. because if the economy starts improving, then interest rates will go up and then the banks will go up because banks can make more money when interest rates climb. So that's a positive. RYT, this is an equal weight technology index. So instead of like XLK, which is not equal weight, and where Amazon and Google and Apple and Microsoft represent like 45% of that index, so that's not that helpful. So I like to look at the equal weight, RYT, and it looks good, telling me that a lot of these tech stocks are doing great and money's flowing into the sector. SOX, semiconductor. I moved back over to this when I was using SMH. I like the SOX more. It has more semiconductor companies in it, better selection. Regardless, looks great. Money's flowing in. Sooner or later, this sector is going to run out of juice. So you got to be really careful with it. If you're stock picking in semiconductors, watch them really closely. Make sure you set your exit rules. Make sure you know what your exit rules are. Book your profits when you're able to if you start getting triggering, if your exit rules are triggering. Don't just ride this stuff up forever because sooner or later you're going to give all your gains back because this is looking pretty overextended. Now, with that said, semiconductor companies are doing great and the semiconductor manufacturers are doing great. I was amazed. I just recently I looked at earnings growth for like Lam Research and KLAC 10 Core, Applied Materials, and a bunch of the semiconductor companies, and they're just going gangbusters. So no doubt that semiconductors have been doing well. No doubt. So that's a positive. IYT, transports, rail, air, trucking, and this is good. You see transports climbing, that is definitely a positive for the broad US economy. Are they expensive? Probably. I haven't really looked at how expensive those stocks are. I have a few in some of the portfolios, but again, this market's kind of going a little crazy and some people are going to get burned. Okay, let's look at some stocks. The first ones you usually want to look at each day is, what are the ultra caps doing? So you bring up Microsoft, Amazon, Facebook, Apple. I didn't bring up Google here, I forgot. And just see what they're doing. You can see that a lot of money was already made. Now they're all flattening out, not really flattening out, but still climbing a little bit, flattening out. And we have very specific things that we look for exit signals, and I don't quite see exit signals yet. And I'd have to bring up more moving averages plus some other things. But sooner or later, these are going to maybe come back to earth. But who knows? You just don't know. And Apple is being repriced because maybe it's not a hardware company anymore. Maybe it's more of a services company. So they have a higher PE that they got repriced for. And maybe they'll hang on to that higher PE. I think it's like in the 30s now versus it was trading much lower than that for a long time. Also I care about what the really highly overextended stocks are doing to see if froth is still in the market. That gives me sentiment indicators. Tesla is still climbing. Shopify is still climbing. And there's probably another 100 stocks that look like this. They just literally have doubled or tripled. Some of these are 3x, 4x. And it just tells me there's a lot of froth still in the market, but sentiment is still positive. You don't want to fight it when you have it. Just want to be careful and have your exit rules in place so you can start, booking profits and getting out and taking profits when you can. Okay, now these are all in no particular order. I think I have 5 sheets of stocks. I've just went through all my portfolios and watch lists and stuff and just kind of randomly grabbed some. So Globe Life. This is insurance. Insurance has been dragging a lot longer than I thought. I had several insurance providers in most of my portfolios, and I got out of them, some of them, because I just ran out of time. So things will sometimes, if a stock just doesn't move fast enough, then it will time out. And I'm like, okay, time to move on. I'm wrong, and it's just taking too long. Just in the last couple of months or last month and a half, some of the insurance companies started popping, and KIE is the ETF that you can watch for all the insurance companies. So, I think maybe the timing is getting better now for insurance companies. Here's Germany. I just threw this one in here because I was putting it in one of my portfolios. I like this breakout here. That looks very nice. AEIS, I think I put this in my small cap portfolio. Has a nice breakout. This line represents a high that this chart had probably a couple years ago, because right now I'm just showing the daily chart. Usually you want to look at the daily chart and the weekly chart next to each other. Always know what the weekly chart looks like and monitor it and look for the levels, look for the past support and resistance levels and draw those levels. Carnival Cruise Line and Norwegian Cruise Line, CCL, actually I dropped both of those just recently once this breakout started happening into the Opportunity Fund. I might get rid of one of them. We have to be very careful with these companies because they still could go bankrupt. They could reorganize. So we have to be prepared for that. And their cash flow is going to be very low until we can get through this pandemic. But you can see that it pulled back extremely hard, probably down 50%. It's been consolidating across here. They still have not gone bankrupt. And I know that they are issuing bonds, and I believe the Fed even is one of the buyers of the bonds. So that allows these companies to stay afloat when they don't have revenue. Shake Shack, that popped up recently. I got in here. I put this into the Opportunity Fund. Nice breakout. TriNet just broke out recently. Macy's way down here, along with Nordstrom's. They're pretty much beat up. Now, Macy's in general, when you look at the weekly chart, it's a horrible chart. The weekly chart tells you that this company's been in a long-term confirmed downtrend for 4 years. So we have to be careful with this. And usually what I'll do is we'll rotate these stocks or we'll cycle these stocks. So they are actively managed. We'll let them get up to a past high. We'll sell, we'll book the profit because usually it'll go up. It'll come back down, give back half the gains. Then we'll get back in. And then this time it'll break up through. So we'll cycle these stocks 2 and 3 times to try to get a total of 60, 70, 80, 90% gain out of them over the next year. Here's Brazil. This looks nice, broke out above here. There is one level way back. It might hit resistance here for a couple of weeks. Kohl's, another retailer, nice breakout here. And this level represents a level that goes back, if you look at the weekly chart. Boeing, one of these days, Boeing's going to be back up to $400. Just don't know when. Just don't know when. We're going to have to be very patient with this money, but very high probability they will not go bankrupt. Very high probability that Congress will bail them out as needed. The federal government will bail them out as needed because they're too large of an employer and they're the only company that really makes airliners. GIII, this is a manufacturer, clothing manufacturer, nice breakout. Wynn Resorts, gaming and casinos, nice breakout. PEJ, this one is leisure and entertainment, so it does have some gaming and casinos in there. And nice breakout. Jets, so instead of buying individual airlines like Delta or UAL, maybe you just buy Jets, because what if UAL reorganizes? If you own that stock, they reorganize, you lose all your money. At least if you have the ETF, you can be better protected. So just a thought for you. Actually, Jets is in our Opportunity Fund. KRE Banking looks pretty good. This is regional banks. It's doing a little better than the money center banks, like the big banks, JP Morgan, Citibank, things like that. Vanek Vectors Agribusiness, MOO, broke out. Let's look at John Deere. John Deere just went straight up. I don't have all the details on that one. Haven't looked too deeply into it. All I know is the chart just went straight up, and that's probably this index. Brazil, nice breakout, looking good. I show Macy's again. Oh, Boeing again. So these are duplicates. PHO, Water Resource Portfolio, nice breakout. This went into our Global Sector Rotation ETF. FXI, China. This one popped, pulled back. You just want to make sure it stays over breakout. If it breaks below breakout and stays below breakout for a couple of days, 2 to 3 days, it's best to get out, book your profit. We were wrong, move on, but watch it closely because you might get back in. It might break back above the breakout, and if it does, give it a couple of days. Make sure you feel comfortable with the breakout, that it's valid. If it is, get back in. Just don't let it break below the breakout. XLV, healthcare, looks pretty nice. This one's grinding a little more slowly than I was expecting, and its relative strength is a little slow, but we're still going to hold on to it. Okay, questions to address from the first slide I showed. The major indexes are taking out new highs. Is this market going higher? Probably. It's probably going higher. So today we just broke out again. Everything has now been in anticipation of Congress passing the new legislation for the coronavirus bill, and it's going to be about $900 billion. And high probability it's going to pass. I think Mitch McConnell and the Republicans know that they have to get something out the door before they go on their Christmas break. So the market's going to be even higher in the next day or two. If it doesn't get passed by tomorrow, Friday, then and it will pop. Then it's going to pop on Monday. They'll probably get it done over the weekend. I will be surprised if they do not get something out the door. So is this market going higher? Yes. How much higher? Hard to know. It's just kind of melting up, and you just kind of take it day by day, watch the stocks closely, make sure you have your exit rules in place. And the market's expensive. It is. How expensive is this market? Can it get more expensive? Yes. Can it stay expensive for a long time? Yes. Are we going to get up to 23 times earnings? Probably for the S&P 500. Is that an all-time expensive market? Yeah, I've never seen it. Highest we saw was 21 times in 1999. Is this market kind of crazy? Yes. I don't like lots of things that I see. I can bring up 250 charts of all the really desirable high-flying stocks, and they just are extremely overbought and overextended. Do I touch those stocks? No, I do not. I don't chase them. I'm always looking for new breakouts, fresh breakouts. And there's just, you have to look at everything as risk reward. What is the risk reward, nature of that trade? So, for example, buying the indexes. Do you really want to buy the NASDAQ composite right now or buy the Qs? Well, so maybe the reward is 5%, 7%, but how much risk do you have? There's a long way down on the risk side versus the reward. So you want to buy trades that have, a much a higher probability of kind of low risk entry points. So if you get something with a fresh breakout, that's a low risk entry point or a lower risk entry point versus buying something that you're chasing, because that's going to be a high risk entry point just in case it doesn't work. If the market pulls back, where will it find support? Well, for the S&P 500, it's probably 3,600 now, and we're up to 3,700 now, and it seems like we've chopped around kind of the high 3,600s to 3,700, and we're now over 3,700, and that this bill passes, we're going to be up into the 3,700s. So that means that, like for puts, when I write puts and sell puts, I'll be selling puts at 36.80 then, 36.70 right there. In the high 3,600s, feeling pretty comfortable that the market's going to probably stay over 3,700. Now, if this bill doesn't pass, yikes, we're going to have some really nasty pullbacks. So get ready. So 3,600 is a good level, but boy, in the next couple of days, if this bill passes next week, I have a feeling the SPX is going to stay over 36.80. I'll be writing puts right there. What will be the best investment strategies for the first half of 2021? All right, so passive buying of index ETFs and other ETFs, or stock picking, covered calls, non-directional trading strategies. I would be pretty darn careful with buying anything broad. The indexes, I would not be buying any of the indexes. I would be stock picking. I'd be looking for fresh breakouts. As I mentioned, you want those low risk entry points, because then if something breaks below the breakout, you can get out pretty quick. You'll lose 5%, 4%, 7%, something like that. That's okay. You're not going to be right on all your trades. You just want to keep that loss, try to keep that loss under 8%. Worst case, 10%, but try to keep that loss closer to 5 or 6% actually. So try to, get into things that have low risk entry points. Make sure you are a decent chart reader if you want to do stock picking. If not, go to stockcharts.com. That's a good place to go for learning how to do technical analysis 101. Just type in technical analysis 101 into Google, and spend 3, 4, 5 hours reading and make sure that you kind of learn some of your favorite chart setups that you're looking for. So I would not be chasing ETFs. I would not be chasing any of the high flyer stocks. Stock picking will work. Covered calls, boy, you got to be careful with that. If you're doing just kind of the boring, well, that's usually the best stuff. You want to buy stocks that are not climbing, and to do covered calls. But when a market isn't a strong confirmed uptrend, your calls can get hit pretty easily. Non-directional trading strategies like our Pinnacle, yes, this is good. We can handle just about most markets. We just don't want the melt up to be too strong. If it's a crash, that takes a lot of work for us. We can get through it, but it's a lot of work, and we won't make money for a month or two if it's a true crash. But non-directional trading strategies will do well because you're usually selling options, you're selling puts and calls, and that's perfect because volatility is still elevated. So that is just perfect right now. The stars are aligned for Pinnacle and for any strategy where you're selling options. Should I sell some of my passive ETFs and stocks as this market trends higher? I would. Yes, start booking profits, just maybe cut a third. They grind a little higher for another week or two or three, and to cut another quarter, something like that. Don't get greedy. Don't get greedy. Don't get greedy. I mean, if you got a 30, 40% gain on a stock, you basically got 2 years worth of gain in 6 months. Don't get greedy. Take it. Is it going to go higher? Could it go higher? Yes, it could. It could. Now, it's better to have exit strategies and know really what you're looking for on certain moving averages and certain indicators, and that's even better. It gives you a better decision-making tool for exiting a stock, and that's the best thing to do. And then usually you want to do it in 2 or 3 stages anyway. So you get that first exit signal, sell a third. You get that next exit signal, sell another third. Or you do it in halves. Sell the first half, get the next exit signal, sell the full. Sell the other half, you're out. There's nothing wrong with that. That's the best way to do it. Should I add short exposure hedges to my portfolio? Not yet. And if if you're wondering, and if you like to buy puts to hedge things, email me. I'm at brad@upsideoptions.net or support@upsideoptions.net or brad@qtrcapital.com. And we can tell you what we're doing and our thoughts about hedging. You got to be really careful when we're melting up. Your hedges could just get slammed, and it's a tough game. When do you buy those hedges? Because all of a sudden you buy a slightly out of the money put or an out of the money put on the SPY, 90-day trade, 120-day trade, and then all of a sudden you have 5 strong up days, and your stock is your hedge is already down 50%. It can happen pretty fast. So it's tough. It's a tough game when you start putting hedges in place. If you want to talk more about hedging, because what we'll do also is we'll write calls against that hedge. We'll write bear call spreads and bring in premium to pay for that hedge. But it's really a job of its own. I have one guy that helps on the hedging, and because it takes a lot of work. You gotta manage the hedges, buy those hedges, keep on rolling those hedges and writing bear call spreads to pay for the hedges. You're trying to keep the hedges really low cost or for free because they can get hit over and over and over again when your market still continues to melt up. What will outperform in early 2021? Value, growth, defensive, technology, small caps, mid caps, large caps. Well, right now, small caps are just on fire. Mid caps are on fire. So if you got a screener, screen for stocks under 10 billion. And then look for the right setups. That's what we do. Look for the right fundamentals, of course. But boy, there's a lot of money flowing into small and mids. Large is slowing down quite a bit. Value, I mean, that everyone has a different definition for value, but I would focus on technology, but at least finding fresh breakouts on tech. But all the tech is so expensive or already overbought or overextended, so just be careful and don't be chasing it. Smalls and mids, you probably can find lots that are just starting to break out, and then trading strategies. Trading strategies are actively managed trading strategies, especially option strategies. They should be able to make money in most markets as long as the portfolio manager, the trader, is very experienced. Should I buy bond funds? No. I mean, if you want just 1%, money market funds, they invest in all kind of the 3-month and under. So short-term maturities are fine. They're not going to get hit too much on rising interest rates. Anything beyond 1.5, 2 years, they're going to get hit. So I would not be in bond funds. Just best to stay out of them unless you just want to put in money market, and that's just 1%, and they're just doing short-term funds, short-term bonds. Okay, so I'm done with kind of looking at the broad market. If you have any questions, let me know. And then the next chunk of this, I got a handful of slides, is I'm going to go over Pinnacle. I'll talk about what an iron condor is, a call spread, a put spread, and things like that. So that's what I'm going to cover next. All right, 1 second. Okay. I just brought up my question pane. Just looks like someone said the sound went away. So I'm assuming that the sound is on. So if you can't hear me, just let me know in the question pane. Okay. Thank you. Okay, so let's look at Pinnacle. All right, so Pinnacle is a conservative, non-directional, income-generating, all-weather strategy. I'm the primary trader for the strategy. I'm Brad. I've been doing this one for about 18 years, and I'm on kind of the 5th iteration of how I do it. Maybe the fourth or 5th. I think this is my last iteration. And the market changes every 3, 4, 5 years. The texture of the market changes, how it moves. Kind of feeling it right now, how it's changed just in the last year, kind of with zero transaction costs, the Robin Hood crowd, younger traders, less experienced traders, feeling that they can just kind of just buy, sell, buy, sell, buy, sell, and it's almost like the day trading crowd that we had back when the market was hot and there was day trading. I basically just pulled back on exposure levels. Also, when Trump got in there, and since he liked to tweet, he would move the markets constantly, and that was definitely a problem. And thank God we got someone in there now that does not have a Twitter account, and that's going to be very helpful, because when you have a Twitter feed coming from the White House, coming from Washington, D.C., it can move the markets. And it was moving the markets constantly. I mean, he would tweet literally at Sunday night just before the market opened, or he would tweet right in the middle of the day, the trading day, and everything was fine. And especially if you're selling options and you got tight ranges, and then all of a sudden a tweet comes in and boom, the market moves. And it just happened over and over and over and over again. That was getting very tiring. So hopefully that's not going to be a problem anymore. I can tell already it's changed because the Twitter feed is no longer really running, and Biden does not tweet. I think he's going to go back to kind of the normal procedures of communicating with the American people. So regardless, I kind of pulled back on exposures. I expose about 30 to 40% of the portfolio steady state at any one time, and I don't go any higher than that. And then, but now when I'm adjusting trades, I do have to go higher than that, but we still have plenty of cash in the account. So we want cash in the account. That's the key. We got to have lots of cash in the account. That allows us to adjust trades and move trades as when volatility hits. So I got plenty of cash, you can sleep well at night, and then with this higher volatility, it's just beautiful, just absolutely perfect. So this strategy is optimized and adapted to the new political era. You know, I'm basically saying when Trump got in there, he can handle the volatility that can come out of Washington, D.C., which can sell off stocks at any time, and that was happening all the time. So this strategy can generate positive monthly returns in upward trending, downward trending, or sideways and choppy markets. This strategy holds a maximum of 3 to 4 positions at any one time, representing 30 to 40% exposure of the portfolio, so we have plenty of cash. Each position represents 10% of the portfolio and is open for 2 weeks. Recently, all of our trades have been open for 1 week. It's just absolutely wonderful. Higher volatility allows us to have a 1-week trade, 5, 6 days, 7 days max, and we're bringing in the premiums that normally would take 2 weeks to get. We hold enough cash in the accounts to make trade adjustments when volatility unexpectedly rises, which happened quite a bit over the last 4 years. This strategy is conservative by construction, which allows us to sleep well at night because we have low levels of exposure, but we're still able to generate solid monthly gains, especially when volatility is still elevated. Targeted returns for the portfolio are 3 to 5% per month after commissions. And now it's just recently, about 5 to 8. The returns will be closer to 5 to 8% per month through March 2021 due to elevated volatility. Right now for December, I'm sitting at plus 15%, actually a little higher, plus 16%, but we'll see. I mean, I might have to give half of that back, some of that back, all of that back. Just don't know. I won't know until December 31st, and we'll see how much I can hold on to. But to be sitting on 16% gain right now is pretty nice. That's a nice gain. Capital preservation and safety are a top priority. We have 17 years of experience in trading and optimizing this strategy. All right, so here's a recent Pinnacle trade. Actually, it's not recent. This is an old trade. Let me just show you what it looks like. Okay, so down here is, let's just see if you guys have any questions. It looks good. Down here is the, what am I trading here? SPX, S&P 500 index. Here's the value of the S&P 500 index. Here's the date, May through September. Actually, this is very old. Okay. SPX pops up, comes back down as a function of time, and this is where it closed for the day, blue. So the SPX was at 29.51 on the close at the end of this chart. Okay. So this is a risk reward. I'm sorry. This is a risk analysis tool for options trading. And let me bring up the next piece of it. And this is the trade that we're going to build. So we're going to build an iron condor. And this is the zero profit line here. X-axis down here is profit. Anything to the right of the zero line is profit, $200, $400, $600. Anything to the left of the line is loss for the trade, for the entire trade, all 4 legs. There's 4 legs on this trade. We're going to sell a call spread and we're going to sell a put spread. The call spread is a 3010, 3020 call spread. We sell, oh yeah, this is 2018. So we're selling the October 18, I'm sorry, 2019. We're selling the October 18, it's a 2019 trade. So we're selling the 3010 call, October 18 expiration date. And then we're going to buy the 3020 call, October 18th expiration date. Same expiration date for this option. Sell the 3010 call, buy the 3020 call. And what that does allows us to bring in a premium. Okay, actually here's the dollar amount. So to sell that call, we brought in $8. To buy this call for protection, it's $5.45, and you end up with a premium. Okay, and that represents this point right here. So I'm selling the 3010 call, I'm buying the 3020 call. 3010 call, actually this represents this call. This point represents this call. We're buying this one for protection. We're buying a call to protect us. All right, for the put, I'm going to sell a put, buy a put. Sell this put, 28.55, October 18th expiration put for $12. And then I buy the one click down, 10 points down, 28.55, 28.45. So I would sell the 28.55 put, that's here. I buy the 28.45 put for protection down here. It creates a spread. I don't want this to be naked. I don't want to sell anything naked. I want to buy something to protect myself. And that's a put spread. So that's a bull put spread, bear call spread. The objective now is I want this index to stay below this call strike, and I want it to stay above this put strike through expiration. And now these were like probably 40 days. Oh, this is a 14-day trade. So 14 days until expiration. So about 2 weeks. So in 2 weeks, this trade expires. And I'm going to bring in a premium, probably close to $3. Actually, I showed here, this was an error. It's about $300, I think. So you bring in about $300. So $300 comes into the account, and $1,000 is being held by the broker as maintenance. because the hypothetical complete total loss on this trade is $1,000 loss. That's what could be a hypothetical loss. Do we ever take $1,000 loss on these trades? No, because we adjust them, we know what we're doing. But a hypothetical loss, if you just opened it up and it went out of the money and you totally forgot about the trade, sure, you could lose $1,000 on this trade. But we move trades, adjust trades, and we never take that type of loss. But the broker holds $1,000, you bring in $300. So really what you're risking is $700. That's your risk. All right, so I just kind of showed this trade here. So we sell this call, buy this call, sell this put, buy this put. Okay, you end up with this graph. This graph is good for a week, 2 weeks actually. So it says 14 days out to expiration. This is the line that you would actually use for risk reward. Okay. And so you'd say, okay, well, you know, I just opened up the trade. I got 14 days left to expiration. On the day it closed, right here on the blue line, what's my risk reward? What's my gain or my loss? Well, it's break even. We're right on the zero line. But let's say the following day, the SPX comes down to here. So you come across and you'd say, all right, I actually have a gain right now. So if I were to sell the trade right now and get out, I'm in a small gain. Okay, so now as time goes, starts clicking along, let's say we're 5 days out. So now we're going to be on this black line. So you can see that it's getting pushed more and more to the right. As long as the index stays within this range, you're making more and more profit. And then on expiration, when you're at 0 days to expiration, you're going to be on this straight line. And that's what the trade looks like right on expiration. So if the index stays in here, you're going to be at this 100% profitable trade and you booked $400. Again, actually I had an error here. It's actually probably $300. So you booked the $300 or you keep it. You're basically keeping the $300. It came into your account 2 weeks prior, but it's not your money yet. You need this trade to expire and you want the SPX to stay right in this range. Okay, let's just look at the trade again. So here's the SPX October 11, 29.55.45 put spread. That's here. So 29.55, 29.45 bull put spread. That represents this bottom half. Plus, we're going to add the call spread to it. So we sold the 3,010, 3,020. So we're selling this one. That's our product. We're selling the spread. I'm sorry. Our product is basically selling this leg. And let me tell you who's buying it. A speculator. A speculator on the other side, all of a sudden the market's up. They get all excited and they're like, yeah, the market's going higher. The SPX is going higher. I want to buy calls. And I think it's going higher. Guess what? We open up our storefront and say, we're selling calls. Who wants to buy calls? And that speculator is willing to pay quite a bit of premium for that 3,010 call. That's right there. And then let's say 2 days later, the market's down and there's all kinds of negative news. Well, the puts, all the bears come out and say, hey, I know this market is going lower. I want to buy puts. So we open our storefront and say, we're selling puts, 29.55 put, come and get it. And we sell this to a speculator. Then of course, the brokers that go between, they're the ones that are matching up the sellers and the buyers. So we don't know who's really buying it, but we know that speculators many times are buying the short put here and that short call. That is the product that we're selling. Then we're just buying this put for protection and we're buying this call for protection. So we're creating a bull put spread and a bear call spread. Add the two together, you get an iron condor. That's this. That's what the iron condor looks like. The put spread brought in $130 credit. Call spread brought in $170 credit. Add it together, got $300. Okay. So that's pretty typical. When we open up an iron condor, we're usually bringing in $250 to $300. That's for a quantity one contract. $1,000 is being held. 250, 270, $300, sometimes 310, 320. If I'm really pushing it and I really love what I see, I might go a little higher, but I usually don't because I like to do this pretty conservatively. So here's the ROI for that trade. It's open for 2 weeks, $300 of premium we collected divided by the 700. That's really at risk because the broker holds 1,000, but we brought in $300. So there's really only $700 is at risk. So 300 over 700 is a 43% return. That's pretty nice for 2 weeks. For a $10,000 portfolio, that's a 3% gain because we were using $1,000 out of a $10,000 portfolio. And again, each trade is 10% allocation of that $10,000 portfolio. And higher credit was possible because volatility has been elevated. Okay. Okay, so someone asked about, am I kind of legging in? Am I doing kind of the top at one time and doing the bottom at a different time? Usually I do. So for example, I just opened up a bull put spread yesterday. We had a trade that expired, 100% profitable. So we kept that $300 for that one trade. Actually, we had two trades that expired. So there's like $600 for a $10,000 account that expired. It was only open for a week. Pretty short. That's very short. This is not normal. They're usually 2-week trades. And then I replaced it. I opened up one bull put spread, and I did not open up the call spread. Why? Because I know that Congress is working on this bill, and we're going to scream higher. And there's a high probability that they will get this bill out the door by Friday or Saturday. That's my guess. If not, I'm wrong. And then my puts are going to get hit. I'm going to have a pretty tight put probably. That's going to get hit probably because it's going to be a nasty, it's going to be a nasty week if they do not come out with that bill. But I adjust everything, so it just creates a lot of work for me. But we'll get through it. But so with regards to not opening up the call, sure. I like to time the calls and the puts, and I'm like, okay, I'm not going to open up the call, and I already had some call exposure anyway, so I was just pausing and waiting. I just want to wait for this bill, and then we'll probably be up 40 points on the SPX, and that's going to get pretty close to 2 of my calls already. I already moved them up. I'll probably have to move them up again, and that's when I'll open up another call spread on that strong up day. So kind of unique that we have all these big events that move the market so much, but it is what it is. You know, we just had the Fed. The Fed just spoke. That's usually can move the market quite a bit. So you have to be really careful when the Fed speaks. They have their press conference, and then in that last 10 minutes when the market is open, usually right after the Fed is done speaking, you could get a pop in either direction. So you have to be really careful. Another person is asking about implied volatility and kind of like delta. You know, what's the delta on the legs that we're opening? These tend to be a little higher. These are not 10 deltas. These are more like 15 delta trades, 17 delta trades. See, I'm really experienced in moving trades and feeling comfortable in moving trades. So I can bring in little higher deltas on the trades. And I'm only opening for a $10,000 account. I'm only opening 3 trades, maybe 4. So only 40% of the cash is being used. I got 60% of the cash is available. And if I open up a 17 delta leg, that means 17% probability of it getting hit. I can live with that because if it starts getting close, I move it. And that's part of the job. So you have to move these trades quite a bit, and it takes a lot of experience, and I feel very comfortable in doing it. And, you know, for example, just today, I had to move 2 iron condors up, had to push them up 25, and when I pushed up 35 points because this market just does not want to stop melting up. And do I know it's going up? Yeah, probably. I don't have a crystal ball. You just have to watch it day to day, and if it starts pushing up, you just got to slide these things up. So I had to roll everything up, and it takes a lot of work, but that's part of the job. All right, so these are the returns again. If you want to see the returns, go back about 15 years on the website, and you can see different iterations of how I was trading it. And this year, we'll see. I mean, boy, I could have a really good December. I just don't know. I won't know until it's all over, but I'm still sitting on 16% right now. We'll see how much I can keep of that, and we can see if I can add to that or if I have to give some of that back. I don't know, but things are looking pretty good. All right, so for Pinnacle, if you want, let us do the heavy lifting on Pinnacle. You know, you can try it for free. You can go to upsideoptions.net and you can see that you can sign up for free if you want. It is recommended to auto trade what we do. All of our strategies are pretty fast moving. The stock picking strategies aren't. You can actually do those yourself, But when we start opening hedges, get ready. There's a lot of movement in there and a lot of work. But Pinnacle is not recommended to auto trade. If you want to learn the strategy in parallel, I recommend opening up an account, auto trade it, but then have your own account and then do it and kind of mirror it and do, in a shadow way. Just kind of do it yourself, watch all the advisories, see what I do, open them yourself in your own account. And if you do it that way, you'll learn much faster if you do these trades all yourself, but it takes a lot of work. And after about a year, you'll start picking it up and getting pretty good at it. But you'll never stop learning. I mean, I'm still learning. And then as the market adjusts and changes and the texture of the market changes, you have to move and adapt with it. And it always kind of keeps you on the edge, keeps you on your toes. So I would not say that this strategy is easy at all. It is definitely not. We open and close all trades. So all trades are auto executed in your account when you auto trade. So you don't have to really do anything if you don't want to. So at your leisure, you can learn it yourself in parallel. These are the available strategies. The ones that I would take a hard look at right now would be Opportunity 1, Global Sector Rotation ETF, Small and Mid Cap Growth, and Iron Condor Pinnacle. So Opportunity 1, it's fully allocated right now. We got 25 stocks in there, but what's nice is that they all pulled back and they're all kind of retesting their lows. So it's a perfect time to get in on that one. And that might last for another month. We'll see. But sooner or later, within 12 months, we're shooting for 50% total return, but I have a feeling it's going to be higher than that. But I'm just kind of being a little conservative on that. And these stocks are still beaten down. And so the vaccines are rolling out, and it should eradicate this virus, this pandemic over the next 6 to 9 months. So, and then global sector rotation. This is just an all weather strategy that I should be able to beat the S&P 500 on it. And I just like how it's global and diversified around the world, because the United States is getting expensive. It's just everything is getting very overextended, and we got to be really careful in what we have here in this country. And then smalls and mids are just taking off, so everything looks good right there. I think this could run for 6 months. I bet we can outperform for 6 straight months with the small and mids. And then, of course, Pinnacle. We can trade through just about anything. Okay, so that is it. Let me know if you guys have any other questions. All right. Let me see what we got here. Sorry, I'm just trying to open up my question pane a little larger here so I can see. Okay. Question about where do you put cash reserves? They just stay in the account. So when you auto trade, at least for upsideoptions.net, this is a newsletter. It's an unregistered firm. That's as all investment publications are. You make your own decisions on allocations on how much money you want to put to this strategy. Let's say you have a TD Ameritrade account and it has 100K in it, hypothetically. You could say, okay, I want to auto trade 20K of that money using Pinnacle. And you can do that. So you set up an auto trade rule, and that 20K just needs to be in that account. I know you have 100 in there, and 100K in there, and you might own stocks and ETFs or bond funds or whatever you have, and that's fine. Actually, make sure it's not bond funds. I'd get out of those. And just have the 20K set aside, and you'll see that gets auto traded. So those are auto executed in the account, and that 20K, again, a chunk of that's going to be cash, but you have to make sure it's sitting there. You do not want to invest it. You want to make sure 20K is set aside and that's being used for the portfolio. So I might be at 40% allocated, but all of a sudden, if we have some big moves, the market goes crazy, I'm adjusting all over the place, it'll balloon up to 50, 60, 70% allocated for maybe a month as I'm adjusting trades to get back to, get things more under control. And I might have a 3 or 4% loss that month, and that's pretty typical. But that's okay. I will have losing months, but I keep them pretty tight. And then when I have the winning months, they usually tend to be pretty big. So it ebbs and flows. So the cash reserve just sits there. Let's say you have a fresh account. You open up an account at Auto Shares and you have 30K and you're like, okay, I want all 30K to be allocated to this portfolio and there's nothing else in there. You set the auto trade rule. It's going to be set for that 30K and that's it. So the 30K is sitting there and then we will trade that account. Just don't make sure you don't buy anything else in there and use any of that money. It just has to be in there. We call that reserve cash or available cash, option buying power. We just need the option buying power. Okay, let's see. We do auto trade through TD Ameritrade or TW. Who's TW? Maybe get back to me on that one. So we have Auto Shares. Oh, Tastyworks. No Tastyworks. Sorry. I've talked to those guys, and I don't think they have it yet. Maybe reach out to them. But the last time I talked to them, but that's getting a little old now. That's probably a year and a half ago. They're like, we don't have that. So Auto Shares is a good place. TD Ameritrade. Now, just be aware that Schwab has bought TD Ameritrade, and we just don't know what's going to happen with auto trading. So if you are starting from scratch and you want to open up an account somewhere, then use Auto Shares. That's a good place to go. Also, Interactive Brokers. Problem is that Interactive Brokers does not have its own auto trade group, so they rely on global auto trading, and there's an extra fee in there. So there's kind of a middleman that does the trades, and they're fine. I mean, I've been sending them trades for a long time, and everything is good, but it's just a little more expensive. So the folks that use Interactive Brokers tend to be out of the country, and because it's easy to open an IB account from just about anywhere. But if you're within the country in the United States, I would open up an account at Auto Shares. Let's see if you get a 75% gain. I'm just reading one of these questions. Okay, one question here is if you get a 75% of the gain in one of the 2 weeks, are you willing to exit at that point, or what guidelines do you follow? Yeah, I mean, we'll definitely close trades early, and it's in general, I want the trade to expire out of the money, and so when I roll a trade, in essence, what I'm doing is I'm booking that gain. Let's say there's a 50% gain on it, but I still don't like it. I feel like it's going to get hit. I will roll it. I'll push it out 2 days or 4 days, and I'll roll it up. Let's say it's a call. It's getting under pressure. So I'll roll it up 10, 15, 20 points, and I'll roll it for a small debit, and so I gave back some of my gain. So in essence, instead of booking 100% gain on that trade, I booked a 50% gain. So we're always adjusting these trades and rolling them, and in essence, yeah, we're closing trades early. We're booking whatever gain we got out of it, and we're pushing it into a new trade that's farther away. So we're moving up those calls, or we're pushing those puts down, one way or the other. Okay. And yes, when we're rolling, you're rolling up. Well, not necessarily. So today, for example, I did not roll out. I did not add any time. I rolled within the same date. So I have some trades that are expiring tomorrow, and I'm watching this melt up, and my calls are getting under pressure. So I pushed up one of the trades and left it as a Friday expiration on the 18th. So it's called rolling it up, keeping it in the same expiration date. And then, but another trade that I was looking at, I'm like, no, I don't want 3 trades sitting here, because just in case Congress passes this bill tomorrow or tonight, and we scream higher tomorrow, I really don't want 3 trades to adjust, because it's a lot of work and it takes a little bit of time, quite a bit of time. So I pushed one out to Monday. So I pushed one out to Monday and pushed it up 35 points, and then I pushed one up and kept it in the same expiration for tomorrow. Okay, let's see. Okay, for this, for SPX, for Pinnacle, are you trading any other stocks? For Pinnacle, I usually trade the RUT and the SPX. And the Russell 2000, I started losing confidence with it because the powers to be decided to only trade the RUT on two exchanges and 2 market makers. And that's not cool at all. not cool at all. I mean, you need really a lot of market makers involved, and where you can move the orders and you can go to different exchanges. You need supply and demand. You need competition. Basically, you need competition, and it kind of turned into a monopoly, practically, or an oligopoly, just a handful of market makers. And so I started really feeling uncomfortable in trading the rut, because I like to trade the rut. So recently I've just been trading the SPX. With regards to a subscription to Pinnacle, does it include clients sending questions? Yeah, I'm very available to anyone. I'm available to talk on the phone. I'm available through email. We usually get back to email pretty quickly. If it's like trade related, and if someone's self-managing and they got a question on the trades, yeah, we're back pretty quick, within an hour, half an hour. If it's a question more generic, we'll usually get back by the evening. And if it's something, sometimes it's more efficient just to talk on the phone. So I'm usually available to talk after 2 o'clock Pacific time. I'm pretty free. So I'm always available. All right, I think that's what we got. For managing money directly under QTR Capital Management. Okay, so now I have the QTR Capital Management hat on. So I'm a registered advisor, licensed registered advisor, and QTR Capital is a registered firm. So we have managed accounts, and it's usually 100K and up on those managed accounts, and we charge, it just depends on the strategy, kind of between 1 and 1.5% of assets under management. Just depends. So because all of our stuff is active, and we put hedges in, so that all takes quite a bit of work. We don't really just buy stuff and hold it. We're traders by training. Even the leveraged dividend income, I mean, that's a pretty sophisticated strategy. We'll buy dividend paying stocks, we'll lever it up by 4 times in the accounts, and then we buy hedges, and then we put 2-stage hedges in place, sometimes a 3-stage hedge. So you can get 9 to 11% annually from dividend generation. And we don't have to worry about timing the market and knowing which way the market's going and things like that. And it's pretty nice. So usually family offices are very interested in that. Family offices that might have 100 million under management, or 50 million, or 30 million, or whatever it is. And so that's who we're targeting for that. But it is available for anyone that is a client at QTR Capital. And if they're looking for more of a steady Eddie, 9% annually or 10% with much lower drawdowns. And here's the beautiful part: if we have a crash and the market stays down, like 2008, for example, 2009, our hedges will kick in, and once they mature, a lot of that portfolio comes back. It's hard to predict because every situation is different, but if the market crashes and then kind of comes back just partially and stays down for many, many months or many quarters, the hedges kick in and the portfolio will come back 80%, 90%, even 100% on some scenarios. So the hedges are nice, and it's a nice portfolio. So for that one, we charge 1.2% of assets under management. So we don't go above 1.5, and actually we probably won't go above 1.4 for our fees. So that's for QTR Capital Management. The website is qtrcapital.com. And anything about 100K and above. And then a lot of what clients usually do is they start with us through upsideoptions.net, start as an investment publication. They'll start auto trading, get to know us, see if they like certain strategies, and then then they'll say, hey, I got 150K, I want you to continue to do this strategy, let's move over to QTR. Things like that. Is there a limit for private family funds? Well, no limit. I mean, well, it just depends on the strategy. For example, Pinnacle, I can't go any higher than 200 million under management. So I got it up to about 100 million in the past, and it was getting a little squirrely. I figured I could get up to 200 million, maybe 150 million. So that's pretty small in the big scheme of things with regards to money management, but it is it's a fund that we probably can't get up any higher than, let's say, 150 million. Right now we're below that, so it doesn't matter. But there's no limit for any individuals. I've had clients that had 500K in Pinnacle, and especially under QTR Capital, we can go up as high as you want. The overall portfolio, total money management, we don't really want to go above 150 or 175 million because we're moving too many contracts. We can move the entire market. When we push an order in for the SPX, and I'm pushing in a particular iron Condor, I could literally move the entire S&P market for 15 minutes, 10 minutes. And then it works against us as we're trying to get fills. So don't want to go any higher than that. And I've already experienced that a little bit. But sure, if clients want to, they got $1 million and want to put into a particular strategy, any amount is fine with us. But it has to be under the QTR Capital, where we're a registered firm, we're licensed, and we're set up for larger dollar amounts. At Upside Options, we're only set up to really handle 100K or less per strategy, if that answered your question. Okay, and then other strategies, same thing, no limit. Actually, leveraged dividend income, that one can handle, we can handle a lot for that one. My partner, he's been trading 3 million on that one, just as he's been developing the strategy. He's been kind of running that strategy for about 4 years, and he has his own money in it, plus he has some other clients, and each client has a couple million in it, and it can handle hundreds of millions of dollars. We're not too worried about that one at all. Okay, well, I think that's about it. If you have any more questions, just go ahead and send them to support@upsideoptions.net or brad@qtrcapital.com, doesn't matter, and we can go from there. All right, well, thank you very much for your time, and I'll see you next time. Thank you.